Marvin asks, could you make a video about ESG? I hear mixed things. Good to rule out certain companies based on values and wanting to put your money where it's doing less harm versus all companies are terrible, it's just the S&P anyways, and just donate the additional money you make. What made you decide to invest in ESGs? Excellent questions, Marvin, and for what it's worth, you don't seem moody at all to me, at least not more than the average Marvin. Environmental, social, and governance are the three factors that a lot of people use to exclude certain companies from their investments with the goal of making their portfolio more satisfactorily ethical, good for the world, so on and so forth. And as we know, the absolute best way to invest in the stock market is with highly diverse, low-cost index funds. So when we're asking ourselves if we want to do some ESG investing or not, what we're really asking ourselves is whether we want to buy some regular index funds or ESG ones. Examples of regular ones might include, none of these are sponsored, obviously, by the way, because my channel has no sponsors other than you. Please subscribe if you find this video valuable and or delightful. Regular ones might include Vanguard's enormously popular VOO, which tracks the S&P 500, or maybe Invesco's also hugely popular QQQ, which tracks the NASDAQ, or maybe even something like VT, which tracks literally the entire world's publicly traded economy in just one index fund. Probably the easiest way in existence to create an extremely nice diversified portfolio while still paying almost nothing in management fees. Like if you wanted to invest in the stock market and you just bought VT and did nothing else for like your whole life, I think that would be perfectly fine. But part of that diversified portfolio is going to be in companies that profit from, and therefore part of your investment profits are going to be from, gambling, cigarettes, fossil fuels, weapons, war, chemicals that kill plants, animals, and occasionally people, junk food that makes Americans weigh some whole number multiple of what they probably ought to weigh while also polluting the entire planet in the process. Just all kinds of really bad crap. So remember here, all index funds are trying to do is invest you in everything and do that in proportion to the size of the companies themselves. There is no active selection of the companies in that fund whatsoever for any reason, including ethics, because these funds just track the whole index. Like the S&P 500, for example, it's going to give you all 500 companies in the S&P 500 in proportion to their market cap. There is absolutely no other goal to these funds. And that's why their expense ratios can be so cheap, because no one's actually trying to pick any stocks. They're just taking the index and putting you in that, right? But ESG index funds start with these same market cap weighted indexes and just pluck out some of the most obviously ethically questionable companies. Those worst of the worst type of companies, the continued existence of which is also kind of like an interesting concept for a future video. Like, it's so weird to me that we know that there are so many companies in the world that are exclusively having a negative impact on humanity and making money doing it, and they just keep existing. That feels very bad. Anyway, the point of these funds is just that you can know that you're not investing in those worst of the worst type of companies and profiting from things like, you know, like bombs, for example. Like actual bombs and bullets used to kill people. So that's what ESG funds are. That's what ESG investing is. And the reason that not really MoodyMarvin is asking about ESG is because I myself, knowing what I know as a former registered stockbroker and financial advisor, have chosen to invest my money this way in ESG funds. So in case you didn't see that previous video with Hank Green and all that, these are the two index funds that I invest in. They're ESG funds by Vanguard that cover the entire US and then everything except the entire US. So together, these two index funds are a super globally diversified portfolio, but without all of those crappy companies doing the most blatantly super bad shizwiz in the world. So basically, Marvin has two questions here. First, is it worth investing in ESG funds? Like, does it really make a difference, or could you just invest in normal index funds and then give your profits to good causes? And the second question is, why do I, Josh, personally invest this way? Well, I think you're going to find that in the process of answering the first one, we're also going to answer the second one. So let's get them. Now, the first thing we need to clarify is something very, very important when we're talking about the stock market. It's that when you buy a stock or a company on the stock market, you aren't giving that company money. You are buying a share of stock from other investors. There are some small exceptions, like when a company does a stock buyback, but like that they're not really relevant. Most of the time when you buy a stock, you're buying it from another investor. And most of the time when you sell a stock, you are selling it to another investor. The only time that a company is getting directly the money from someone buying a stock is in an IPO, an initial public offering, when the company itself is giving out those shares of stock for the first time. They can also issue more shares in the future, but that's pretty rare. So we call the stock market a secondary market, where investors are just trading with other investors. Now, if you are really into this stuff, or you just know a lot about the stock market, you might be thinking something in the back of your head at this point, something along the lines of, but hey now, Joshua, doesn't buying a stock make the stock's price go up And doesn't selling a stock make the stock's price go down? And doesn't a company's stock price being high mean they might have more capital available to invest in new projects and such? And doesn't that mean that by buying a company's stock, you could drive the price up and indirectly help them expand their operations? Yes, but only kinda. All of that is true, but there are at least two factors that, even for an ethically inclined investor like me, make this point basically entirely insignificant and not worth worrying about. First, little non-multimillionaire investors like you and me just are not going to make that much of a difference in the prices of these gigantic multi-hundred billion dollar companies. And especially when we're talking about these big index funds that are mostly composed of big tech companies anyway that aren't getting plucked out of these ESG funds, the difference that any one of these oil or tobacco or gambling companies is going to feel in their price as a result of your buying and selling of them is just really small, like simply not significant. And even if you were a multimillionaire and you moved your entire portfolio from a non-ESG fund to an ESG fund or vice versa, it's not going to make a difference in the scheme of these companies whose valuations are in the hundreds of billions of dollars and who are probably a very small percentage of your index fund's market cap anyway. And second, let's say that in some fantasy alternative version of reality, a bunch of gigantic institutional investors and asset managers managing trillions of dollars all teamed up and said, you know what? I think our customers would like it better if we removed all of these bad companies from our funds. So Vanguard, for example, says, you know what? Inside VOO, we don't want the S&P 500. We want the S&P 400 companies that are the most ethical. So in this fantasy world, all of those big asset managers sell all of those companies, and the stock prices of those companies do absolutely tank from all of that selling. So all those bad companies are the exact same companies doing the exact same work. It's just now their stocks are much cheaper from all of the selling. Well, at that point, if there are still any investors in the world who don't care whatsoever about the ethics of their investments, and believe me, there are literally millions, if not billions of those people in the world, those investors are now going to look at the low as heck prices of these companies that were just a much higher price that probably made more sense based on the amount of revenue that they take in, and they are going to decide to put even more of their portfolios into these companies because they seem like good deals. So they're going to buy that company until it's back up to roughly the price that it was before, because there's an opportunity between where the price used to be and the way the price is now, and until it comes all the way back up, it's a good deal. So they're going to buy it right back up to what that price was before. The price it was before people started selling it for ethical reasons, because they don't care about the ethical reasons. So their fair price, they think, is right back where it was. So the reality is, unless almost everyone in the world decides at the same time and permanently that they don't want to invest in these companies anymore, the price of this company or whatever bad company is probably going to end up right back where it started. At least that's what the efficient market hypothesis would lead us to believe, and if you ask me, it's probably the case. Like, maybe if Vanguard and BlackRock and all of them started selling these companies, it would exert some downward price pressure on these stocks, but we had to invent a fantasy scenario just to create a situation in which that might be the case. And even then, it kind of seems like it wouldn't be a permanent downward price pressure. It would just kind of give morally unscrupulous people an even better way to make money, because now they can buy these, like, you know, less ethical companies on sale, basically. So I don't know. Ironically, I feel like it would kind of funnel money to less morally scrupulous people and be kind of counterproductive. And one final note here, if you're thinking about Wall Street bets influencing the price of meme stocks like GameStop and AMC as clear examples of retail investors having a real impact on the price of a stock, there is at least one huge difference here. And it's that when all of this meme stock craze around GameStop started, GameStop's market cap, meaning the total value of the company, was only about $250 million with an M, which is literally 1,000th of the cigarette company that we're going to talk about, meaning it would take about 1,000 times less money to move the price of GameStop stock as it would to move the price of this cigarette company's stock. Plus, the Wall Street Bets folks were driving the price of GameStop up, not down, which is fundamentally different in several ways, but that's a very deep and complicated rabbit hole, so we're not going to go down there. The point is, critics of ESG investing are entirely correct when they say there's no realistic scenario in which individuals buying and selling a company based purely on ethics would actually meaningfully change a gigantic company's stock price in any long-term or noticeable way. And again, that effect is even more blunted in an index fund, where these companies are only a small percentage of the fund. And importantly, just because someone is investing in, for example, a cigarette company, doesn't mean that that money that they invested is now going to be used to make and sell more cigarettes. Because unlike when you actually buy their products, when you buy a company's stock, you are not giving that money to them. You are giving it to a different investor who wanted to sell it. But by owning a share of, let's say, Philip Morris International, they're the ones that make Marlboro cigarettes, you are now a partial owner in that company. And as such, you are going to get a quarterly dividend. At the time of writing this script, PM's dividend is a pretty substantial 3.72% on an annual basis. And when you receive that money every quarter, you can be certain that it came primarily from selling products that kill people. But of course, that's not all. In addition to that dividend, as an owner of Philip Morris stock, you'll be benefiting from any increase in the value of Philip Morris as a company. And their stock is up over 67% over just the past 2 years. So unfortunately, business in the highly addictive poison-based death sector must be increasingly good over the past couple of years. So obviously the point that I'm trying to make here in light of our ESG discussion is that both the dividend payment you receive and any gains that you glean from the increase in the value of that stock will definitely be from the production, distribution, and profitable sale of highly addictive and highly deadly products. That is where your profits are coming from. But especially since we're talking about investing in index funds here, you might be asking yourself, if investing in the company doesn't necessarily directly help the company do more bad things, does it really matter where the profit is coming from? It's a valid question, but the stock market is very complicated. So to help you get your own answer to this, let's try to make it a bit simpler to think about. Let's go way back in time to the Middle Ages, where, congratulations, you are a very rich merchant looking to invest some of your extra gold coins or whatever. So you hired an investment advisor to find opportunities for you. He says, yes, this is definitely a man because this is the Middle Ages. He can split your money into 2 different investments, each of which will usually get around a 10% return per year. Verily, you say, but just out of curiosity, pray thee tell, what are those 2 businesses? And he tells you that the first one gives loans to farmers so they can expand their plots to feed more people, and your profit is the interest on that loan. It's a win-win. Now, do consider that you are just buying some of those loans from another lender, so it's not like your money will be directly helping farmers build more plots, but your profits will indeed be from the sale of food that would not have otherwise existed or fed anybody. Verily, you say again, because that is verily cool. This information, you say, has made me feel quite well and good, and so pray thee tell mine goodly advisor, what is the second enterprise? He tells you that the second one addresses another problem in society. Oh good, you say, do tell. He explains that there are, of course, so many orphans in the streets, as you have no doubt seen, and no one has known what to do with them until now, because the king has created a program in which certain private entities may buy a certificate allowing them to legally take these poor children from the streets and out of the city entirely, where they will be sold into slavery, working the land in the countryside. And your profit will be the difference between the cost of hiring these orphan grabbers and the price the orphans fetch at the slave market. The result? No more orphans in the streets, and both investors like you and the slave traders will profit. It is a win-win-win. And your investment advisor sees the look on your face and says, before you start feeling too uneasy about the nature of these profits, do note that just like the first enterprise, you're just buying a certificate from someone who already has it and wants to sell it. So it's not like your money will be directly helping orphan grabbers grab even more orphans, but all your profits will indeed be from the sale of children into slavery. Now let's bring it back to the 21st century. Just like ESG versus non-ESG funds, the returns on these businesses are essentially the same. And your investment isn't even necessarily directly helping more of either thing take place. But the profits are, for sure, from very different activities with very different impacts on society. So how are we feeling about putting your money into one versus the other. Now, please do form your own opinion, but personally, I'm wondering if Investment Bro can't find me literally any other place for the second half of my money. Because when I am particularly flush with money from one bumper year in the child slavery trade, I don't think I'm going to feel great about that, even if I didn't directly cause more of that to take place. Like when you're able to put a new mantelpiece over your fireplace in your medieval home and your spouse is like, oh, that's wonderful. I love this mantelpiece. How did you afford it? And you have to be like, child slavery? I'd be like, do you think that your spouse would be happy about that? Do you think your children will be like frolicking in front of this mantelpiece and be like, oh yes, goodly mantelpiece. I'm glad we have that. But taking it all the way back to Marvin's comment here, what if we just take the gains from a non-ESG fund and do some good with them? Invest them in some good causes or whatever. Give away your money and try to do some good to offset the bad. Like maybe I buy the Philip Morris stock, but then I give my dividend to cancer research, like maybe even specifically lung cancer research. It's a good question. And you could do that. In fact, I've heard this argument a few times, actually many times in the past, from people who think that ESG investing is pointless, mostly from articles about people who think that ESG is like a violation of fiduciary duty because you always need to be just getting your investors the best return no matter where it comes from. There are tons of people in the world who make that argument. But there is one absolutely enormous and obvious and extremely ironic problem with it coming from those people who say that it's all about your investment return. Because as we've already mentioned, the returns on ESG funds and their non-ESG counterparts are usually extremely similar. Sometimes they're very slightly higher and sometimes they're very slightly lower, usually based on how specific icky sectors are doing, like mostly the oil sector and whatever the people in charge think about that sector. But again, just slightly different, because most of the time, the vast majority of these index funds are still holding the exact same stuff with just a few particularly dastardly little douche nozzles plucked out. But notice what this means. If the returns are the same in ESG and non-ESG funds, but then because you want to offset the harm done by all the douche nozzles you're invested in the non-ESG fund, you give some of your profits to charity, whatever amount you give to charity, you now have that much lower of a return overall than if you had just bought an ESG fund and not had to offset some evil. Your investments are underperforming the ESG funds. So if you're going to do that, then why not just buy the ESG fund? I mean, you could still even give the money to charity if you want, but also like, even if you do give part of the proceeds to good causes, or maybe even all the proceeds to good causes, I don't think that justifies doing bad things. Like, imagine I go steal a bunch of kids' lunch money and then I give 100% of that money to No Kid Hungry. Is that a good thing? I don't think so. And no, in the investing example, you're not actively causing more kids to have less lunch money, but if you could profit basically the same from a less heinous enterprise, then why wouldn't you? Or let's think about it another way maybe. Let's imagine that a cigarette company like Philip Morris even gave like 10% or even like 50% of their profits to lung cancer research. Does that make you feel better about taking whatever's left over from that as a dividend? Well, personally, no. It sounds like the ethical version of greenwashing. So if it would be weird and scummy if they did it and wouldn't make their enterprise any better, any more ethical, then why is it any less weird ethically if they gave the money to you first as your dividend and then you made yourself feel better by giving that same money to the same place? Like, aren't you then just ethics washing your portfolio? And again, you could have just not invested in them. So like, it always feels like such a weird argument to me that like, oh, just do the same thing and then give the profits to charity. Why wouldn't you just not invest unethically? And if you want, then give those profits to charity. And I'm not trying to make you feel weird or anything, or actually, I guess maybe I am, but what I'm trying to demonstrate here is just how weird these ethics really are. Do you want to profit from people's deaths? Is it enough to give some of that death profit to charity? Is it even enough to give all of that death profit to charity? And when you could just profit approximately the same amount from not death, then why would you even do the death thing? So that's why I don't do the death thing. Because to answer the last bit of Marvin's comment that we haven't really touched on yet, there is this conception out there in some circles that all companies are terrible, but Are they? Are they all equally terrible? I'm going to give you some companies and you can just tell me if they are good or bad, okay? So Philip Morris. Bad. Yeah, like I think so too. Okay, then how about Amazon? Yeah, lots of terrible work conditions there for drivers. You got the environmental impact from encouraging over-consumerism. But if we're being objective here, you could argue that people might have just been buying that same stuff elsewhere anyway, in even less eco-friendly packaging, because at least Amazon does sort of try in that regard. And they did pioneer a $15 minimum wage plus benefits for their full-time workers. So that's a lot more than most companies like Walmart or whatever. So you tell me. Are they good or are they bad? File that away. How about this third one? Duolingo. Full disclosure, at the time of writing this, I have about a 1,349-day Duolingo streak and some of their stock in a fund representing a very small percentage of my net worth as a little experiment for a possible future video. Et je parle français à cause de cette application. So I am a little biased about this company. It is a software company that teaches people languages for free with ads or paid with no ads. But they did come under fire recently for using AI to do their work more efficiently, creating more language courses in less time. And a lot of people thought that was just great, whatever, that they're creating more courses that teach people stuff. But a lot of people hated it because they said it replaced work that humans otherwise could have done. That is the most controversy by far that this company has ever been in. They're otherwise completely fine. So Duolingo, bad company or good company? Honestly, fight me about it. I say they're a good company, like purely a good company. That's actually why I started investing in them in the first place, like several years ago when I was still picking stocks, because I was like, dude, I want to invest in stuff that's really making a positive impact in the world and not producing like a bunch of waste and polluting the planet and stuff like that. They seem like the best example of that I could find. Like, this is a company producing almost no waste that pollutes the planet, paying people well for what is mostly highly skilled work, to be fair, and the product that they ship is purely, inarguably good for people and fostering human connection in a world where that's getting really hard to come by. Like, as a very personal example here, my wife and I went to Peru recently, gotta finish editing that for my other channel, and we ran into a very surprising number of French people. Some of them didn't speak English or Spanish, and voila, I got to communicate with those people. And to be fair, it did take me a few years of using Duolingo to learn French before I could have like full-on conversations like I can now, but I mean, like, that is a whole lot better effect on me than 3.5 years of cigarettes. So in a fantasy scenario in which you could get the same return from any of these three companies, which one would you rather profit from? Philip Morris, Amazon, or Duolingo? And are these companies equally ethical or equally unethical? Are all companies just as terrible as the rest? I just don't think so. And I don't think it's easy for people to think that way. Like, it's a lot less mentally taxing to just sort of throw up your hands and say, capitalism sucks, all companies suck. I don't really need to think about this topic with any more nuance than that. I'll just throw all my money into the S&P 500 and think no more about it. It is easier not to think about where your money goes, just like it's easier not to think about where your trash goes, or what kind of factory farm your meat came from, or how your coffee from the other side of the world could possibly be that cheap. It's slave labor, child labor, it's both. But just like all of these other massive ethical issues that have crept into our modern lives, partially because we let them, I think where we put our money matters. What we decide to profit from matters. We can't just pretend that it's all the same stuff in there. We can't just pretend that there's nothing that we can do about it and that it's all really the same ethically. At least I can't, because I know that there's a problem, and I know that there's an easy way that I can at least very easily stop personally profiting from it. And now, so do you. But anywho, if you got something out of this little chat of ours, please do help me get some traction here on this teeny tiny little microscopic speck of a channel of ours by boinking all of those big beautiful YouTube buttons. Every single click of yours really does have a positive impact on the future of this channel, so subscribe if you're new here, ask any and all of your questions in the comments because there's a very good chance that I might answer them in a future video like this one, and please, for the love of God, have a good day.
If you ain't talking money, don't talk to me. I be over here where the bosses be.